Hey, good morning, everyone. Marty Missouri here, November 20th, 2021, with your weekly macro update. I am actually just going to rifle through the update this week. When I look at all of the data and indicators, et cetera, that I've compiled for these videos, so much of it just has to do with market stuff. And I think I'll save that for next week's technical videos, where I'll offer up maybe some deep fundamental commentary on markets as well. As we move toward the end of this year, I can really see setups emerging. Actually, some pretty compelling setups are some of the positions that we're in that we've just taken here this year and added to. But as you know, I've been expressing my concerns over the market internals. We talked a lot about breadth. That's really looking dicey right here, for lack of a better term. And it's interesting heading into next year because, as I've expressed here as well, I think as the calendar turns, we may see a notable turn in terms of the type of market action and sentiment and things that we've been experiencing. And I did mention sentiment earlier in the week. It is picking up, and that's not actually a tailwind. That's more of a headwind the more it picks up as people move more to the bull side of the boat. You square that against things like the really ugly breadth, you begin to wonder if indeed this seasonality is going to work out like it typically does, or is the market just kind of positioning itself for a little different regime going into 2022. Again, opportunities for sure that we want to exploit, risks for sure that we want to hedge against. And I want to give you more texture on what I'm talking about, particularly in terms of those opportunities. But for today, let's just do our exercise on the macro. And in front of you is our chart. Nice move, by the way, up about 8 points this week to 29.17. The needle movers were retail sales, housing permits, industrial production, and then the U.S. Economic Surprise Index. So again, that's a nice move. And I guess you could say we're breaking through that downtrend line, broke through it, tested it, and now we're moving back higher. So that's a nice look from a technical perspective. We'll see how it plays out. I have to tell you, concerned with what I'm seeing in the COVID numbers. Austria shut down night before last on a national basis. Europe just had a terrible time in their equity markets pretty much across the board yesterday in response to that. We know that the numbers are rising in Europe. We know that they're turning back up here in the US. Oil just rolled over hard yesterday. I suspect that had something to do with that. Oil's also dealing with some seasonality. The politicians are really trying to talk down the price of oil. Oil structurally, with all that's going on with the push to green energy and the push to hamper the expansion of fossil fuel production, got to be bullish on energy companies for an extended period going forward, just based on what's going on throughout the world that surround the energy markets. But yes, it's going to come with a great deal of volatility. We are hedging our biggest energy position against something major, and that just kind of expresses how we think about the space. We do think there's potentially some big volatility, but beyond that, we like the energy sector across the board, definitely for the foreseeable future, notwithstanding, I'll say it one more time, a lot of volatility along the way. Jumping into the charts, retail sales, 1.7% month over month, 16.3% annualized. Online sales continue to creep higher. We got to have a little context, though, of course, when it comes to retail sales, and that is they're price weighted. So retail sales go up when prices go up, but of course, people need to keep buying them as well. Barron's this morning equates about half of the move to inflation. And so again, people picked up their spending a bit in the face of some really deteriorating consumer sentiment, as we've talked about. But understand that a not small part of it has to do with rising prices. The high frequency red book, it looked like they're kind of consolidating in here. That's been off a little bit for the last couple of weeks, and I mentioned online sales are improving. So I mentioned housing permits, but actually housing starts were down month over month. However, and as you might imagine, much of the time the housing permit numbers are a precursor to what we see the following month when it comes to housing starts. And if you look closely, you can see here the prior month, right, we actually had permits tick down a little bit and starts tick down. Well, notice this month permits ticked up a little bit, so we'll see if next month we don't see an improvement in housing starts as well. Home builder confidence saw a nice increase to 83. That was better than expected. Digging into the report a little bit, looking at Peter Bookvar's notes. I really appreciate the guy because he does a nice job of parsing these reports. We read many of them as well, but if I don't get to all of them, I can always count on Peter to give me the gist. Present situation rose 3 points to 89, but the future component was unchanged, which is interesting. Prospective buyers traffic improved by 3 points, but it's still off of its recent peaks. That score is a 68, but recently it was as high as a 77. So the caveat, he says, in addition to well-publicized concerns over building materials and the national supply chain, labor and building lot access are key constraints for housing supply. Lot availability is at multi-decade lows, and the construction industry currently has more than 330,000 open positions. So clearly the issues regarding labor have not abated as of yet. Although, as you'll see in my industrial production commentary here in a second, I think it's safe to say that things are beginning to improve on that front. Here's that industrial production. As you can see, it's improved here of late, and that's better than expectations. There's an 11% month-over-month rebound in motor vehicles and parts, and that's after big declines, so coming off of a low base. They're still down almost 4% year over year, but according to Peter Bookvar, again, they're hearing anecdotal stories of auto companies bringing back plants that were temporarily closed because of chip shortages. And then we track capacity utilization, right? To what degree are factories utilizing their capacity? And you can see that's on the move higher, it jumped to 76.36%. And apparently a decent chunk of that has to do in the auto manufacturing space. And then lastly, the U.S. Economic Surprise Index. Remember, this one's interesting. It's the actual data coming out in comparison to what economists had previously expected. And so the economy improved a lot better than people had anticipated, and than I had anticipated too from this point. But again, $6 trillion of fiscal and $4 trillion of monetary support can do strange and wonderful things for an economy. And of course, we cannot forget that dynamic as we move forward into a world coming off of that kind of support. And then of course, here suggests that economists got really giddy and the economy didn't deliver, and consequently economists got more pessimistic, and now, like per our index this week, the economy is outperforming economists' expectations. So that's good, and we're seeing some improvement in the rest of the world as well. We track several, so let me just click on this. You can see this is the Eurozones. A little bit of improvement there, still notably negative. Got to be concerned about the COVID data. Japan is coming off of just really disappointing expectations. We do like Japanese equities a lot going forward. I've shown you the technical picture. We're looking at a 30-year breakout that looks pretty substantial. China looking much better of late. Interestingly, it's almost into the positive territory on their surprise index. Emerging markets overall pretty flat but bottoming, and then the global index itself is just starting to turn back up. So again, economic data relative to what economists had anticipated is showing us a better look here of late. So folks, I'm just going to cut it right there, and hope you have a wonderful weekend. It will probably be early next week when I reach back out to you with more of the market-oriented data that we are paying very close attention to. There's a lot of it there, so you're probably going to get a series of videos going forward for the next couple of weeks. Thank you, as always, for watching and listening. Be back very soon. Bye-bye.